What's up, stock traders? My name is Mike Huddy here with Clover Trading, and I'm very excited today to talk to you guys about the secrets of my trading success.
Secretly.
Of course, secretly.
If you find this video helpful in any way towards your trading journey, make sure you show us some love. Hit the like button, ring the bell so that you are notified when we release free content on a weekly basis. In this video, I want to teach you guys what it really means to preserve capital. In the beginning of your trading career, that is the number one most important thing. And the only way you are going to preserve capital is to learn exactly what I mean by risk-reward management. How do I size in? How do I choose price targets?
I don't know.
We have two really good stocks in the AI sector that are going to emphasize these points. Let's get into it. You're going to hear my thesis on the two stocks and why I'm doing what I'm doing, but more than the thesis, I really want us to focus on the structure of the risk reward. You hear me talk about it all the time. The daily chart kind of tells me if I want to be involved, and the price action, the intraday action, is going to tell me how much size and when specifically to buy the stock. And you're going to see both of those scenarios depicted in AI and SOUN. So AI is a stock that I am working on a long-term swing, and long-term might be a month, it might be 2 weeks. It's just longer than a 2 or 3 day time frame for me. Reason being is AI was kind of that main runner, that very simplistic name approach where I think a lot of investors can have interest in this stock. It's also the one that held up the best relatively near its highs after its phenomenal run back in January, holding up in that top 30% threshold of the whole run. If you're looking at SOUN, topping out at 5 and coming all the way back down to $1.50, definitely did not hold near its highs. So AI feels like the strongest, feels like the simplistic of names, feels like the biggest market cap maybe is in terms of the ones that actually were volatile. So this one I think has a lot of interest and focus. And what I found really interesting about AI is in the midst of this banking crisis, it seems like a lot of traders have forgotten how much of a monster AI is, how new the technology is, how innovative it is. And what I find I have the most edge behind is when stocks are not running off of fundamental variables, but they're running off of perceived hype or perceived disaster. When things are no longer running off of fundamentals and running off of psychological perspectives,
Perseverance! Yeah.
that's where I think you have emotional moments to take advantage of. So in this whole AI, what's baked up into this chart right now, what I saw is we had this good earnings reaction and it sold off, kind of complementary to the overall market. And while everyone was kind of focusing on doom and gloom in the bank stocks, we actually built a very nice base on the AI ticker, held this $20 level, which we've been holding for pretty much the past 2 months. And again, while everyone's focusing, this base that it's built is quite nice. The price action has consolidated in a very healthy manner. The level that we held is very interesting. It is a very nice support level. And the reason it's a nice support level is because eventually, if this stock gets back up to the 31 area to break out, if people still can visually see a good risk reward scenario, they're going to still be interested in buying. Rather than a stock that just spikes from the lows all the way back to the new highs, people are going to be scared to buy that because it's such a sudden move. But the more structure that the stock has, the more interest people will have from a technical standpoint, right? So I want there to be good risk reward baked into the chart. What I'm seeing pretty much here is, as I said earlier, you're having this really nice base formed at $20. So pretty much what I did was on this breakout of 22, I started buying 22.20. And the idea was I'm going to risk $20. So I'm risking $2 a share. And the idea is back at the breakout level, if it can get back up there, that's 1 to 4 risk reward. I'm risking $2, my entry being 22. I'm risking 20, this bottom level low. And I'm entering at this middle line. And again, the idea is if this gets back to the breakout level and sets up for a nice multi-month breakout, I'm in from the lows. And at the breakout level, I now have a 1 to 4 risk reward position. And I don't need to buy it through the breakout level. I can let the rest of retail chase this stock higher and allow my risk reward to expand greater than 1 to 4. And I can sit back in a position where I can either choose to break even or take a smaller loss for a gain that can be much larger than the loss. And that's the purest dynamic of risk management that you could possibly have in the market. But let's talk about the intricacies, I think I said that right, of risk management. And specifically, I want to talk about how I would size into this play. So let's just use a for example, this is not reality, but let's just say I wanted to risk $1,000. In my opinion, you can have consistency in a number of different ways. You can be consistent in which setups you approach. You can be as consistent in your risk. You can be consistent in where you take your rewards. Is it a percentage? Is it a formula?
It can be anything you want.
For me personally, I like to be consistent in my risk approach. I never think about the reward necessarily. I mean, I think about it.
We all do.
I'm not concerned with the reward when I'm thinking about position sizing is a better way to say that statement. So let's just think about AI, and here, this is how I would frame it as I'm taking the position. If I wanted to lose $1,000, let's say I thought this play was worth $1,000 of my money. Well, in order for me to size in with $1,000 risk, given the confines of the chart, not what I want to risk, but what the chart is telling me I have to risk in order for the setup to be valid, this is what I would have to do. I would have to buy 500 shares at 22, risking 20, because that's what the chart tells me to do. So if I'm buying 22, risking 20, 500 shares, or a $10,000 position, 10% risk pretty much would be $1,000 loss. So 500 shares at 22, risking this lower line. If I lose $2 a share, I lose $1,000. My total equity in the position would be 10 grand. You know, maybe it's 10,000 rounded, right? But let's take that exact dichotomy and apply it to SOUN. SOUN is a bit different. The stock is much further off its highs, but is now consolidating in a very nice way where it's holding its original structure, its original breakouts range, and starting to consolidate in a very tight range as AI is pushing higher. So I'm starting to think that if day traders feel like they've missed AI, they might start stabbing at sympathetic plays, stocks that also ran during the time that AI ran. Now these plays are going to have a lot less merit. There's going to be a lot more overhead. There's a lot other variables in terms of press releases and offerings. These are not stocks that I'm very curious in swinging like I am AI. But if they are going to get that momentum, if they're going to get that volume, I do want to capitalize on these in much more of a day trading type of aspect. See, the nuance is different because of the daily chart context is different.
I'm different, yeah, I'm different.
But let's talk about specifically the risk reward on SOUN. Again, we went over AI. If I'm buying 22 and I'm risking 20, I can have 500 shares, which is a $10,000 position, and I will lose $1,000 if I am wrong. Let's look at SOUN. And let's say I wanted to have the same exact position as I have on AI. Well, let's see exactly how that looks. For this AI play, what I'm seeing is this stock has gone on a run from $1.57 to 2. And over the past 4 or 5 days, it's consolidated in between 2 and $1.88. It's a 210 high and $1.88 close. So the whole range here is 20 cents. And I'm thinking in my mind that if this starts consolidating near the highs and starts to go sideways, kind of like we saw in AI, I want to buy the break of the sideways consolidation. And what that risk reward will be in that moment, I will size into to the lows. And that's exactly what we got on Friday. Every day we kind of spiked into 2 and faded, spiked into 2, faded, spiked into 2, faded, and
I'm faded.
held 188 each time. Friday we spiked into 210, and then instead of fading, held 2. So we held sideways in between 210 and 2. So I started buying $2, this whole $0.50 idea, thinking that 2 should hold, and if it doesn't, I can be out for a small loss. And the risk in this specific moment, if I'm buying 2, risking $1.88, is 12 cents of risk. And again, the whole idea here is I would rather be buying 2, risking the base low of 188, than buying 211, the highs, and risking 2, which is a more of an arbitrary level that it can or cannot hold. Whole idea being, again, on AI, I don't want to buy 32 and risk 20. I want to buy 22 and risk 20. It's the same thing here on SOUN. I want to, instead of buying 210 and risking 2, I want to buy 2 and risk 188 when 2 actually holds and proves that it's significant. And so in this circumstance, if I want $1,000 of risk, here is the biggest lesson of the video. Here's what you have to listen to.
I'm taking notes.
If I'm going to risk $1,000 and I'm buying 2 and the risk is 188, okay, accounting for slippage, let's say I wanted to lose $1,000, I'm pretty much buying 10,000 shares at 2 or 199 or 188, being very specific about my entry in this circumstance, making sure I don't chase this at all because that could seriously throw off my equation. But if I want $1,000 risk, right? Don't care about the equity, but $1,000 risk, I would have 10,000 shares in at $2, risking 188. And in this circumstance, I would have $20,000 in the stock. So understand that my equity just doubled. I have $10,000 in AI for a $1,000 risk, and I have $20,000 in SOUN.
I think I'm gonna puke.
For a $1,000 risk. So in theory, the SOUN risk reward is better. Even though the chart might not be better, the thesis might not be better, but the way that the price action has developed, SOUN is showing us that it is better. That I can have more size, more equity in this stock for the same $1,000 risk, holding all things consistent, making sure that there's no offerings or just purely looking at the price action. Now let's look at the reward. In order for me to get 1 to 5 on AI for this $1,000 risk, I need AI to spike $10 a share. I need, this stock to go to 32. Because if I'm in at 22 and I'm risking $2 a share, well, a $10 spike, 22 to 32, would be 1 to 5. Now, if I'm risking 10 cents a share and I have $1,000 risk, 1 to 5 would be a 50 cent spike. So all I need is this 250 level, this upper line that I have drawn. Well, that's only a 20% spike relative to AI, which is damn near 35% from 25, let alone 22, it's even greater, right? It's closer to 50%. So I need less of a push on SOUN to maximize my risk reward because for the same risk, I have double the equity. And SOUN, given a good gap up and a good market on Monday, could be at 250 in a day. Whereas I think AI, given how the risk reward is set up, it's going to take more nurturing. It's going to take more time. And if you guys can understand this very simple concept and start to think about it before you take trades, you too can be deadly in the market.